All right, so today we have our joint presentation with National Bank Direct Brokerage and Vanguard ETFs. And today we're going to do kind of like a mid-year check-in to see how markets are doing, how the overall economy is doing. So lots of exciting stuff today. So my name is Anne. I know some of you might have attended my webinars before, so welcome back. And I'm one of the business development managers. But I think who we're most excited to see here today is I have Ashish, who is the Senior Investment Strategist at Vanguard. So before I continue taking over, Ashish, would you like to introduce yourself?
Yeah, just start off by saying, thanks for inviting me in, and pleasure really to join National Bank Direct Brokerage. So just a little bit about myself. I work with our global investment strategy team. I'm developing an economic and market outlook and focus predominantly on Canada. So responsible also for research and model portfolios for Canadian investors, and also provide clients with investment strategy and portfolio construction guidance. So it's a pleasure to be here. Thanks.
Perfect. And with all the intros out of the way, let's get right into our mid-year check-in. So before I begin, nice little disclaimer. The gist of it is just to understand that National Bank Direct Brokerage is self-directed. So just make sure that you're doing your own research and your own due diligence before any investment decisions. Now, to kind of kick us off, Ashish, we're at the halfway mark throughout the year, and AI, it has gone from the stuff that was made from our dreams to technology that a lot of us are using every day in the real world. So you have more and more people using it. They're using AI daily, the same way that they would use Google or even a light switch, your cell phones. So what does AI mean for the overall global economy?
Yeah, great question, Anne. So I started with saying, in these kinds of contexts, what really works well, I find, is analogies. So in the context of AI, we feel that it's emerging as a general purpose technology and really highlight the word general. So more really like electricity using that analogy, and more transformational, in fact, than computing. And that can really change entire economies, not just industries. It can drive productivity gains and structural changes. And in fact, in our view, it will have that broad-based impact like electricity. So technology and technological, I would say, megatrends have been the most powerful drivers of economic outcomes, of economic progress. They contribute to things like GDP growth, interest rates, and even impact market valuations. They've done that for over a century. So AI has the potential to trigger what we would call a multi-decade productivity surge. And if it offsets some of the headwinds we are facing, particularly in the US, things like aging population and a lot of debt. As we know, the US carries a lot of debt. So the impact of artificial intelligence really we feel will be felt globally, particularly if it emerges as the winner against some of these structural headwinds. So I think this is a very simple slide, as you can see here. So I'll start off by saying we were still in the early adoption and investment phase in 2026. So a GPT has what we would call a J curve. And you might have heard that term before, and it's just like the alphabet. It's like a J curve. So productivity is lower generally as companies reorganize, they change legacy systems, they reorganize their workforce and those kind of things, and overcome worker reluctance, I would say, towards a new technology. And this is what we call adoption fatigue. So if you think about it, again, you get an analogy. So more modern, we would say modern electrification really came into the fray in somewhere around the 1880s. So you saw power plants being built, grids being built, but the early uses of electricity were really limited. So they were limited to things like lighting, that had really a niche focus. But then what happened was factories started reorganizing, the adoption really increased in some of the urban areas. So the bottom line is really technology can take some time to materialize, but we're seeing the good news is we're seeing really the early impact of productivity. But what's happening is the broad diffusion has not taken place, and we expect that to be the likely scenario. So much of the U.S. GDP, as you can see in this graphic over here, is really we're expecting growth of about 3% for 2027 and 2028. And in fact, if AI is transformative, it could go on for even 6 or 7 more years. So early stages, the productivity is the The growth in GDP is actually explained by an increase in capital expenditure, and over time it diffuses, and we see the benefits of productivity. So really, bottom line, we could see a growth of 3% for even 7 to 10 years. Moving on to this slide, this is a very simple slide that looks at our two different scenarios. So the first one, obviously, is AI will transform, and what will really happen is it'll lift all sectors simultaneously. And this is what I meant by kind of the word, the word general. If it's a general purpose technology, it doesn't impact just a few subsects of the economy. It in fact impacts the broad economy. So be enhanced worker output. There'll be a strong augmentation of tasks. But people, I know there's this dystopian feeling that people will be replaced. So what will happen, according to our research, is their roles will generally evolve and new jobs will be created. Now, of course, like every technology, there will be some job losses, and we'll talk about that later. But what you will really see is economic reorganization, business models being rebuilt, and we'll see some real benefits where you'll see sort of, for example, some of the structural headwinds where you have an aging workforce will kind of be overcome because now older workers will be able to focus on less strenuous tasks and work and participate in the labor force. But really, it's that bleak scenario that you have to also be aware of, and this is the scenario that will lift GDP, but it'll only have a one-time impact. And think of it like an automation scenario: people losing their jobs. What you'll see is aggregate growth will really fail, but you'll still raise GDP per capita. So in this scenario, it really won't have a meaningful and sustainable impact on the economy.
That's some great insight. And kind of building onto your thoughts on AI, I'm hearing a lot about capital build out. So I'm hearing a lot about capex and spending. So what does this all mean in real terms?
So this is a chart. I mean, it looks very complicated, but it's really not. If you just look at kind of the y-axis, as you can see in the line, it says change in share of GDP percentage, and it looks like the years from the investment cycle on the x-axis. So ChatGPT was really introduced in November 2022, so we're about 3.5 years away from that. And what you see in these capex build out is a clear trajectory. You see a rise in share of GDP, you see it plateau, and you see it fall. So our bottom line message is we're still really in the early stages of this, and we'll really start to see the productivity impacts later. As you can see, that T line really looks at the AI build out, and it's been rising, and the dotted line really shows we expect it to rise more, and then we'll start to see it diffuse across different sectors where general population will really start to benefit from that. So this is a really interesting slide, and what it really shows is so I'll start off by kind of saying that there's a lot of discussion in the markets about how, especially the S&P 500, how concentrated the markets are. So and it's the most concentrated it's ever been historically. So if you look at kind of some of the technology stocks, and you take the technology sector, and then you add the Mag 7 and remove the overlap, that's about 50% of the market. So a huge chunk of the market is really concentrated. But interestingly enough, when you look at the kind of impact technology is having, it's very, very broad based. So technology has only a 7% share of total investment. And you can see that that's the current state. And if you look back to 1949, you see farming actually had 12% concentration level. So these are industries that are really impacted by technology. Electrical power was 7%, and we can see a different statistic there. So the top two, in terms of concentration level, is much is indicating that it's much more fragmented. So the broad message is that the stock market might be concentrated, but the exposure to different sub industries due to artificial intelligence is very fragmented, and that means we could see broad based diffusion.
Good stuff. And yeah, thank you for explaining that. I feel like I hear a lot of buzzwords in today's I guess market, especially with AI, and it's good to get some clarity on that. And there was something you mentioned earlier. I like the word doomsday that you mentioned. And speaking of doomsday, there's a lot of doomsday scenarios around AI that are floating. Not exactly Skynet, but there's a lot of concern in the media about AI disrupting the workforce. What's the actual reality about that?
So, and Actually, this slide is my favorite slide, and we recently added it to our Outlook. And it really looks at an empirical example over here. So what we're really seeing is people were really worried in the 80s really about how bank teller employees would really lose the jobs when the ATM was introduced. But actually, what we see in this slide is that bank teller jobs actually remain fairly consistent until really the adoption of mobile banking, and that came 20 years later. So these jobs were really not eliminated overnight. And the great thing that even though these teller jobs declined, and this was really partly, as I mentioned, due to mobile banking adoption, um, other banking roles from 1983 to today actually doubled. So we can see that new jobs are created. Some of the new jobs that didn't exist in the early 80s are digital product managers. We never had those. We didn't have cybersecurity experts in the 80s. And these jobs really reshape what I would say our workforce. So the bottom line is really a technology appears to be disruptive, but it may take time really to result in job losses. There could be a creation of new jobs, and these jobs would actually involve people who are at a higher skill level, which really impacts positively our GDP. So you can see, for example, product managers, cybersecurity experts, you require more skill than say just a bank teller. So this slide over here is that again, our view is that most jobs will not be eliminated; they're going to be augmented, and AI will really reshape tasks and um, instead of really just eliminating entire occupations. And so jobs will evolve. And our view is really more than 70% of jobs will actually see a meaningful increase in time savings. So interestingly, if workers are more productive, demand for these workers will actually increase. So I have a good analogy here. So, when the X-ray machines were actually introduced, people actually thought that radiologists would lose their jobs. And very similar to the example we discussed earlier, but radiologists, they do a lot of different things. They interpret the scans, they apply sort of medical judgment, and they communicate with a lot of people, such as doctors and nurses. And most importantly, I think they understand their patients, inside out. So the demand for radiologists actually increased after the X-ray machine was introduced, contrary to what a lot of people thought. And part of the reason was because costs went down. So X-ray machines became fairly affordable and really allowed radiologists to focus on more complex tasks like that required human decision making. So AI will replace routine and repetitive tasks, which according to our research we call rules-based cognitive tasks. But it will also create jobs that, as we mentioned, that they really didn't exist before. So this chart here, just very briefly, it looks at the jobs in that orangey mustard color, such as system development, documentation, coordination, and even I would say legal assistance. Like those kind of jobs won't really do that well, but there'll be other jobs that will do very well, and there'll be new jobs that will be created. And so at Vanguard, we constantly talk about the fact that we rely on a very data-driven framework. We don't, just come up with our views like that. We actually look at what the data is showing. And here, what we're really seeing is that we're looking at job growth and real wage growth. I think a lot of people want, obviously, their real wages to grow after inflation. That makes their standard of living better. Obviously, you want to be in a job where there's strong job growth because demand for workers will go up. So here, what we see is contrary to what many occupations with high AI exposure have actually had both higher job growth and higher wage growth, really dispelling a lot of those myths that you hear that youth unemployment is due to AI taking over jobs. Actually, we looked at some of the interesting stats, and one of the interesting stats that I came across was that it was, I believe, it was 63%. We have 63% more university graduates in the last 10 years, but only 16% um, increase in the demand for people with post-secondary education. So it's more of a structural problem. It's not just like AI is taking over our jobs. So we don't see that really happening, and particularly both in the U.S. and Canadian economies.
And I love your use of scenarios, especially that bank teller one. It's really nostalgic, and especially for myself working in a bank, different banks over the years. You're right. It's not just a quick snap where AI kind of starts removing things really quickly. It's very transformative, like you mentioned. I do have a question from the audience, though, and someone is asking behind the idea of how investment is more fragmented, even though the S&P 500 it's more concentrated than ever before. Do you see the S&P 500 being less concentrated in the future now that investment is more fragmented?
Yeah, that's actually a great question. So now it's very hard to predict what will happen, in 5 or 10 years. But what we can see is historically the levels of fragmentation and concentration tend to be higher in phase one of an AI build out and a new technology. So phase one is really when the builders of a technology benefit. So you can see in this case it's the Max 7, and in phase two, as productivity starts to diffuse and disseminate, we actually see the beneficiaries, those that leverage the technology benefit. So overall, according to history, and as I said, Vanguard, we look at probabilities, magnitudes, and facts. We do see over the time concentration would likely go down as there'll be creative destruction. You'll see new entrants come into the market and really erode on the profit margins of some of the existing winners. So bottom line, yes, but no one predicts with certainty. And great question, thank you.
Thank you, Ashish. And speaking of predictions, I know at Vanguard we never really speak in absolutes. Unfortunately, we don't have a crystal ball, or at least one that works well. So, I guess, in your opinion, what are the upside and downside paths ahead?
Yeah, and this is also a really interesting chart. I really like this one. And so here we look at probabilities to the AI transform scenario. And we also look at the more dour scenario where AI is not transformative. And so we attach about a 55 to 60% chance of AI really being transformative, and only a 25 to 30% chance of it resulting in really displacing a lot of jobs and more focusing on automation. Now, you might be asking me, I think the question is, why doesn't this add up to 100? And it doesn't add up to 100 because there's also a different scenario. And this is the scenario which most of the market thinks is going to happen. The Congressional Budget Office thinks it's going to happen. The IMF thinks it's going to happen. And this is a scenario where you have 2% growth and 2% inflation for the next 10 years. So that is also a scenario. But in terms of really analyzing some of this chart, so when we have this AI transform scenario, which is really our base case, we will have sustained productivity growth. And so AI will be a true general purpose technology, as I said. And again, if you read Coming Into View, that's a really good book by our chief economist. He really has a really interesting chapter where he discusses, the aging workforce. And really, a lot of people say, even people over 65, think of people in their early 70s or late 60s, really being able to contribute to the economy in this scenario by doing less strenuous work. And you'll see labor participation increase, and that really contributes a lot to overall growth. So this is the AI transform scenario, and you can see in the AI transform scenario, automation. This is the risk of us losing our jobs will be very moderate or even low, but it's really augmentation will take place, and that's really what we could do. I would put it in simple terms, or we put it in simple terms, is things you could do in 5 days now you can do in 4 days, which really, interestingly enough, gives you a reason to ask your manager for a raise. So those are positive outcomes for society, but we have to also be cognizant of that bleak scenario over there. And in that scenario, it's possible that it'll really replace workers, and that will actually will increase GDP growth, but it'll have a very temporary impact. And it'll really have a limited impact in terms of diffusion. It'll just be concentrated in a few sectors in the economy. Next slide, please. So a very simple slide over here. And what we're really looking at here is a 60-40 portfolio. And we can see that this is really looking at the impact of AI being transformative. So you can see the more transformative artificial intelligence is, the higher the returns for a 60-40 portfolio, according to our research. So if AI is transformative, you can expect to have somewhere between 6 to 8%, and on the downside, around 3 to 5% returns.
Thank you for that. And I guess next we'll move on to the economic outlook. And I know AI is exciting, but AI isn't the only force that's driving our economy. So, what's your forecast for the remainder of the year?
Yeah, so actually, we think that Canada is the Canadian economy. I'll start off there. Much better situation that was predicted I think a lot of people remember the so-called Liberation Day. So some were predicting, 10% unemployment. You have a 3-year recession. So very different scenario. And I think the Kuzma tree is actually helping us quite a bit as an economy. So we're really the lowest tariff country amongst the US's major trading partners. And I would say that, overall, I'd say the US to be Canada, even despite a lot of their strong GDP growth and our estimate for 2.3%, which is really above trend, they have a lot of concerns, particularly tied to, for example, one is inflation, and another one is a lot of their growth is just coming from artificial intelligence. So really, they need to do business with Canada. So we're quite constructive. We have our aluminum here that goes out from Quebec, a lot of it, 90%, in fact. We also have potash that goes into the US. So really, I think it benefits them. It puts downward pressure also on inflation if they do business. We've actually seen a lot of progress that has been made, particularly in the Online Streaming Act, which Canada actually recently removed. So they were charging a 15% tax. I'm sure a lot of people on this call actually listen to Netflix. So when you actually, oh, sorry, watch Netflix. So when you watch Netflix, the Canadian government actually wanted to charge a 15% tax and encourage a lot of American companies to produce Canadian content and use that 15% to produce Canadian. So they actually got rid of that. So we're seeing a lot of negotiations go through, and we see in Canada actually core inflation has come down significantly. And that's really what matters a lot in terms of the policy rate. And we are, as we'll get into later, in the economy, a low hire, low fire environment. So very difficult for people to enter the labor force right now. But those who are established are doing fairly well. And we actually see the policy rate at being 2.25 for the year, which is really overall good for the economy. And then we see strong growth in the US, and that really also positively impacts Canada. Just moving on to the US very briefly. So, as I said, decent growth there, 2.3%. A lot of it really coming from capex. We also had the one big beautiful bill, so that actually a lot of it focused on deregulation, also tax cuts, so that helps the U.S. economy. Obviously, inflation is still very high in the U.S., above target. So there's some upside risk, we would say, from tariffs, energy prices, and we don't actually expect any cut right now, particularly because of inflationary concern in the U.S. Moving on to the euro area very briefly, so quite muted growth there, below 1 cent. They've really felt the brunt of some of the higher energy prices that we've seen and some of the tighter financial conditions there. It's really slowing economic activity. They're very exposed to oil, as we know, and inflation is starting to reaccelerate. But really, they're in a much better situation than they were, when last time, during the Russia-Ukraine war when it actually started. So much better position they're in, and also they're very much exposed to the energy sector. So that's one of the downside risks. And then finally, concluding with kind of China, I think we know that the domestic demand is really quite slow there. They have a property sector borderline, I would say, crisis. It still remains a drag there. There's a debt deleveraging story that needs to be worked out there. And then you see inflation is very low in China. And there's fiscal policy, and fiscal policy in China is very targeted in terms of how they deal with the economy. So they're really focusing on AI there, and obviously green technologies. And they have actually successfully kind of diversified their trade exposure outside of the US. Great. So this is really looking at kind of different scenarios from the effect of higher oil prices in the major economies that we've discussed just now. So as we can see from this chart, actually, so I would say with actually started Canada's GDP, it actually does better if the Mideast conflict lasts 1 to 2 quarters. So we have three scenarios. One where it lasts 1 month. That's obviously going to happen. It's already lasted more than 3 months. So we see a middle scenario where it lasts 1 to 2 quarters, and then more than 2 quarters. Now, what I'll say is, I know everyone's really been following the news. in terms of what's happening in the Strait of Hormuz. Now, we're not saying that it's a scenario where you have to be completely optimistic about the outcomes, because remember, it's still a memorandum of understanding, and this will go into effect on Friday, and it really calls for a 60-day ceasefire. So it's not something that's really permanent. So the situation is fluid. There's vulnerabilities that remain, but really the base case, and we've always felt that is this conflict is going to last 1 to 2 quarters. And so as it lasts 1 to 2 quarters, Canada's economy will actually benefit. We're obviously an oil exporter now. As an oil exporter, government revenues rise. You also start to see better margins, profit margins for some of the companies that have that kind of exposure to energy, and so they'll start to do better. But and so you could see in a situation, the longer this crisis grows, the more the disparities start to happen. So you'll start to see maybe Alberta's GDP be twice of the national average. You'll start to see only a subsect of the population really starting to benefit, and you'll start to see inflation kind of expectations start to rise. So this conflict, would say, is still fluid. We don't really have a permanent outcome right now. But really, the middle scenario from a GDP or productivity perspective is actually the most optimistic scenario for the Canadian economy.
Thank you for that. It's really interesting, and I know oil prices is one of the hot topics in the town. But aside from that, where do you see interest rates going?
So yeah, I mean, I think this is a question we actually get all the time. So the bond markets were, earlier in the year forecasting 1 to 2 hikes for Canada, now closer to one. We really don't think that the Bank of Canada is going to hike. So one of the things I guess a lot of people learn in economics is demand pull inflation. So this really what's happening in terms of the situation in the Middle East. It's not really demand pull inflation. There's not excess demand, and monetary policy is really not an effective tool at dealing with more supply side dynamics. So that's one reason why we really feel that there's not demand pull inflation. If there was more reason to hike, and core inflation, actually, which we'll get to in the next slide, not just right now, but it has really decelerated. We've actually seen slowing population growth in Canada, which puts a little bit more downward pressure on inflation. We've actually seen bond yields actually also tighten, which really, a lot of us actually have 5-year mortgages or plan to have 5-year mortgages, and you can see that really tightens up for credit. So we have less discretionary income. So overall, and the labor market's not exactly strong. So we don't really see the Bank of Canada hiking. Now, in terms of cutting, again, we talked about monetary policy. It's not really an effective tool in dealing with sort of some of the trade scenarios we're facing with the U.S. So when you lower interest rate, it broadly impacts the whole economy. You can't be targeted and target certain sectors. That's where monetary policy comes in. Like you can simulate all you want, but the auto worker in Woodstock, Ontario is not going to get their job back. So that's one of the things. And also we feel like fiscal policy in Canada is going to be quite stimulative. And given that it is stimulative, that actually sets a floor on how low interest rates can go. So we'll move on maybe to the next slide, which goes over inflation, which is very connected also to policy rate decisions. So overall, I'd say quite good news here, as you see in the chart. It's been going down, especially you can see total CPI actually went up, but what we also care about is CPI median and CPI trim, and these are really inflation gauges that the Bank of Canada looks at and evaluates. And you can see they've both been on a downward trend. In fact, if you really strip out energy, core inflation is around 2%. So that really means things are under control. And there are a number of reasons. One of the things I mentioned earlier, there's demand pull inflation. And one of the reasons for that is there's slack in the economy. So there's really what it means is that there's an output gap. So aggregate supply higher than aggregate demand. The demand really just isn't there. So there's slack. And what we've seen actually is rents and groceries. I know a lot of people on the call think they're very high, but they're actually decelerating. So we also have slowing population growth. Now, you think about population growth, that really puts a lot of pressure on, for example, housing, particularly in Canada. So given we have slow population growth, we've seen the housing market really be sluggish. Rents are coming down. In fact, we actually saw mortgage interest costs year over year be negative for the year. So given all that, and also we had retaliatory tariffs removed, most of them, not all of them, and that really takes time to disseminate and diffuse into the economy. So overall, I'd say inflation is very contained.
Thank you for that. And I do have a question from one of our audience in relation to US debt and how it relates to the GDP. So US debt is now higher than GDP. What are your thoughts on how it could impact the global economy?
Yeah, that's a great question. So the U.S. deficit to GDP is actually extremely high, and it's been it usually isn't this high. It's usually this high during periods of wartime or during recessions, and we're really, as we've seen, 2.3% growth. We're not in recessionary times here. I mean, not here, but in the U.S. So what we do see is that the U.S. can really. There's a few ways to get out of this debt. One is you can deflate your way out of debt, which you really don't want to do because that's really going to create a lot of have ripple effects in the global economy. But the way you can kind of work your way out of debt is also by having higher productivity. So that really brings us back to that AI transformative scenario. So if AI is truly transformative, we do think that the U.S. will, that productivity, what it does, you can do more with less. So it puts downward pressure on inflation, and you start to have higher growth. And you start to have higher growth, you can really work your way out of this debt. So despite how massive it is, if AI is transformative, our view is that the U.S. will really be able to overcome this. Of course, if AI is not transformative and just stays within its sectors of origin, we actually do think that it will be quite bad for the markets, and you could start to see ramifications globally, as we've seen. So stock, you could have a decade of lost market returns, essentially at around 0 to 1%, according to our analysis.
That's really insightful. Great question, by the way. And Ashish, you mentioned Canada's population earlier, and it had me interested in the overall demographics. So, how is Canada's population growing, and what impact do you see on our economy?
So I'm sure, great question, and so I'm sure a lot of people here on this call have heard the headlines recently. Canada is in technical recession. So I urge people to really look beyond some of these headlines. So, although it is technically true, you've had 2 quarters of negative growth, we really don't feel that the Canadian economy is in a recession. Now, there's to classify something, the Canadian economy as being in a recession, you have to look at the 3 Ps, which is what the CD Howe Institute really looks at. So it has to be pronounced, pervasive, and persistent. So let's talk about pronounced very briefly. So pronounced is something that has a high magnitude. So minus 0.1% is not really pronounced, sorry. And then you have to look at it being persistent. So persistent, okay, we've had 2 quarters, but it's really not gotten uh, to be longer than that. And then you look at it being pervasive, and we don't see, as we talked about earlier, we actually see divergences in the economy. We don't see things as being broad-based. After all, the economy in Alberta is not doing too bad. We actually see unemployment rate in Quebec City is only 3.6%, I believe. So given that, we don't think Canada is in a recession. And actually, what drove some of those Q1 numbers down was just the government not spending too much on defense. So now that we've kind of looked at that, I'd say some of the areas where Canada is really struggling on as we know, is productivity. We have low business investment, and we have those sectoral tariffs that are really weighing in. But I think this chart, sometimes a chart tells is worth 1,000 words, and we can really see here that if you look at those mustard-colored bar charts, what we actually see is Canada's population had been growing, and now it's declining. And this is the first time since we've been actually tabulating data that Canada's population has declined in a quarter. So it declined in Q3 and Q4 of actually last year. So what that's really done is actually the positive thing that has happened is our GDP per capita, this per person, has actually gone up. So we've actually, because a lot of the people who actually are no longer part of the economy were concentrated in low wage jobs. So bottom line, I'd say it's not all the dour news. And I won't spend too much time on this slide. This really looks at what's been really driving the slowdown in population. And you can see like the level of asylum claimants has been up and just a little bit, but fairly static. Whereas you can see the big declines in work permit holders, study permit holders, and they're really the ones that are kind of weighing in on population growth. And kind of on the Canadian economy, I like it kind of with the job outlook. I think everyone really cares about that. So I'll start off by saying very volatile in terms of the numbers. We've seen the labor force survey. We had over 100,000 jobs lost from January to Marchish. And then we had this huge pickup in May where there were 88,000 jobs created. So our view is really, and we do this with the US economy, to look beyond some of that volatility, focus on some of the longer term drivers. And so really what it is we're in a low hire, low fire kind of environment. And I know a lot of people might be trying to enter the workforce. I'll be very honest. It is very tough for younger people to enter the workforce. It is very tough for returning workers to really enter the workforce. But for people who are established, it's quite good, the scenario, because we haven't really seen a pickup in aggressive firing. But things can pick up if for younger workers, if particularly some of the uncertainty is removed and we kind of see a pickup in kind of a constructive sort of dialogue on the Kuzma and constructive negotiations on Kuzma. But again, as I said, tale of two cities. You're seeing, for example, in London, Ontario, unemployment rate is like 8.5, around there, 8.5%, and Quebec City obviously much lower than that. And what that is due to the makeup, because you see London, Ontario, less so recently, but it's still a manufacturing town. Quebec City, a lot of government workers, a lot of people are really not dependent on U.S. policy, and we actually see youth are really struggling. We actually see people who are in the prime age population from 25 to 54. The unemployment rate is actually only 5.6, whereas with youth, it's like almost triple. I'll say 2.5 times that. But just end with kind of saying an interesting stat that I found is again that that 16% increase in the demand for university educated workers over the last decade, whereas kind of the number of university grads has gone up by 63%, which is obviously makes it tough for younger people to really enter the workforce. So this has been something that's been going on for a decade. It's not because of AI that it's tough. And also, don't forget, we also have the trade issue where there's a lot of uncertainty, so businesses are not more reluctant to hire.
Yeah, great insights on that. And yeah, almost a great way to address the elephant or maybe many elephants in the room. So, really appreciate your insight on the unemployment. Speaking of other factors that contribute to our markets moving really quickly, markets, as you can see, everyone can see really, they move really quickly and they react to geopolitical shocks and headlines. How are investors reacting to it?
So, Anne, I'd say actually very well. So it's really interesting here. We see that retail investors have stayed disciplined during geopolitical shocks. Our message is always, stay disciplined. Focus on the long term. And geopolitical shocks can actually be short-lived, and that's really when the equity risk premium is higher. So don't really panic and withdraw your money. When things like there's a war or something like that. And what this chart really looks at is the daily portion of investors trading equities, and that has been pretty constant. And it looks at something called the ratio bull to bear ratio. Very, very simple ratio. And this just compares the number of investors that expect prices to rise versus investors who expect prices to either to be fairly constant or perhaps fall a little bit. And we see that we feel that in you know um, anchor really to the long term and really be focused in terms of your goals. Really define your goals, stay balanced, which really means diversifying your asset allocation exposure, have equities, bonds, and then really in terms of some of the difficulties in the market, as I said, not panicking and withdrawing your and going to cash.
Yeah, some great insights, that's for sure. And I'll be honest, nothing that we haven't heard before. It's always good to get outside once in a while and touch grass, maybe take a step back, really take a look at things from a different lens, from a longer term lens. So I really like that reminder for all investors out there. With that as well, do you have any final thoughts for us?
Yeah, and I'd say the one other thing on the last slide I'd say is just stand that um, you know, there are a lot of things you can control and some things you can't control. One of the things you can control is really cost. So, to encourage our clients to really focus on when they're investing, really focusing on low cost investing, and that really can help your returns in terms of any scenario, pretty much. Now, just end by saying is, our outlook in terms of for those clients that really have the ability to take on some risk, and perhaps the risk of underperforming in and really benefit from maybe perhaps longer term better outcomes. And this is what we, in terms of our outlook. So we actually see as technology, as we said, we're in phase 2 right now. So it diffuses across different sectors beyond its origin. It'll really start to diffuse, and that'll really benefit sectors outside of US growth. So I know a lot of clients are actually thinking, okay, US growth has done really well in the past, but remember, we go through periods of history when there's a new technology. The second phase actually benefits those companies that actually leverage the technology. So think of sectors like professional services, healthcare, education, some of these value sectors, they'll start to benefit. And if it's a general purpose technology, which you might think it is, and this is actually our base case, will start to diffuse beyond the sectors where it originates from. So our real message is the builders of the technology are not the eventual beneficiaries when it comes to equities. So we're saying really look up at US value stocks. They also have good valuations, quite strong dividend yields. Also look at international stocks. So look outside the US, look at also Canadian stocks. And as for bonds, I would say we really like Canadian credit. So it offers attractive expected return. We did have positive real yield in the 2010s. Now we actually have a time where we have positive real yields. As I mentioned earlier, balance is very important in the portfolio. So that diversification in your portfolio and having really some high quality in there. So a lot of Canadian credit is actually fairly high quality. And we also have a lot of longer term initiatives that are being undertaken by the government of Canada, which are really focusing on nation building activities that should really impact productivity, that might also impact Canadian corporations which issue Canadian credit.
Wow. Amazing final thoughts. And honestly, I learned a lot in our little mid-year check-in. So thank you so much for all of your knowledge and your insights, Ashish. I'm sure we all really appreciate it. Before we kind of get to maybe a couple more questions, you might all be wondering, okay, so how do I get some exposure to some of the sectors, the certain industries that were mentioned today? So what I'll do is I'm going to share where you can find more information about National Bank Direct Brokerage. So feel free to visit our website at nbdb.ca. And for those of you that don't know who we are, you might have heard of our trading commissions. So our claim to fame, if you want to call it that, is we don't charge any trading commissions for buying and selling Canadian and US stocks and ETFs. So whether that's buying into a stock directly or buying or selling a Vanguard ETF, it costs $0 if you're doing it with NBDB. A couple things I do want to highlight on our trading platform. And for those of you that do have accounts, feel free to follow along. If you don't have any brokerage accounts with NBDB, you can easily open one on the website. So research in terms of where to find different types of ETFs. If you wanted to add some diversification instantly to your own portfolios, take a look at our trading platform. And specifically under the research tab, since we have Vanguard here, take a look at the ETF research section. And when you do click on that link, it should prompt you to download a PDF that links to all of the ETF research that our National Bank Capital Markets team does. And there is a specific report that I do want to highlight. That is the Exchange Traded Funds Canada and US link. So once you click on that, it will then generate a very interactive, I almost call it a master list of all Canadian and US ETFs for all different ETF companies. And they are sorted based on different categories, different strategies. I know we mentioned a lot about Canadian sectors, but also US sectors. So you can search it up by category just by clicking on it. So let's say you wanted to invest in ETF that is focused on Canadian large cap companies. When you click on it, it gives you a master list of all the ETFs that are invested in Canadian large cap companies. And as you can see, there is one for Vanguard, or If you're not too sure on which category to look for, but you want to do a keyword search, you can take a look at, let's say, oil. You mentioned that a couple of times. You type in the keyword for oil or any other energy sector, and it'll show you a whole list of ticker symbols that are ETFs related to what you're interested in. So feel free to check that out for free on our trading platform. And we are pretty much at the end of our presentation. So I will also just kind of go back to our website here, showcase a few things. So if you want to learn more about investing overall, our trading platform at NBDB, do check out the Learning Center. And you can also sign up for any future webinars that we have. We also have our YouTube channel. So for those that are brand new to do-it-yourself investing, the YouTube channel is a great way for you to get some short little snippets, little videos, how-to guides on how to navigate the trading platform at NBDB. And I will leave up the customer service contact for how to get in touch with National Bank Direct Brokerage. And Ashish, thank you so much for joining us today. Everything was really, really insightful. I know I learned a lot, and this was a great mid-year check-in. I'm almost looking forward to hopefully a year-end wrap-up if we can do something like that with Vanguard. And let me just do a quick scan for any other questions if you can stick around and answer a few, Ashish.
Yeah, for sure. Thank
Perfect.
you for inviting me, by the way. It was a pleasure.
Oh, you're always welcome back, I'm sure. I do have a question here, and I think this is more so if we rewind it to maybe the first half of your presentation. Um, we have a viewer asking, with more jobs to be created, what areas provide good investment opportunities beside the crowded space of direct AI players, such as semiconductors, model builders, providers? What are your thoughts on that?
Yeah, so that's a great question, and we kind of touched on it before. So, given fairly high valuations in terms of the Yan mentioned there about semiconductors, model builders, and hyperscalers, we actually think that there's a lot of risk embedded in some of those firms. There's a lot of firms that are obviously during when we had the computing kind of the PC boom and the tech boom in the late 90s. A lot of those companies actually don't exist anymore. So the builders are not the eventual beneficiaries. So we think that the opportunities are not there as much with the builders, as we talked earlier about some of the concentration levels, the max seven, even net of double counting plus technology stocks is over 50%. And some of the beneficiaries will be those that leverage the technology. So as I mentioned, some of those, what we have done a lot of research on is actually things we even get very detailed into things like the DuPont ratio and breaking down the drivers of returns. And what we do find is that a lot of these value oriented companies are actually going to be able to lower costs. And what we found is lower costs by decreasing their selling, general, and administrative expenses by automating tasks. So, really, if you're focused on the long term, our view is really you can't predict what will happen next year in the markets. So, and some of the builders of the technology might again have another blockbuster year. But if you're looking and we encourage investors to have a longer term time horizon, if you have 5 or 10 year time horizon, something like we've done scenario analysis on this, almost 80% chance of some of the value stocks to actually outperform growth stocks, and very much so even with international stocks. So I believe that is around a 75% chance. And as I said, at Vanguard, we look at probabilities and distributions. So we've done the research now. There's a likelihood that 20% or the 25% chance might materialize. No one can predict the future, but the odds are generally in your favor by going outside of the builders of the technology and more into international niches and value stocks.
Perfect. Thank you so much, Ashish. And I think that's it for questions. So it's a really, really great, informative, and interactive session today with you, Ashish. So thank you so much for sharing your insights. And to all of you, I hope to see you at the next webinar. And I hope you all learned a lot today. So stay tuned for any future webinars with NBDB and Vanguard. And with that, I wish everyone a great rest of the day. Thanks, everyone. Take care.
Thank you.